Good afternoon. Welcome into another episode of Market Talk for this Wednesday, January 19th. Great to have you with us. Thank you for making us part of your day once again. I'm your host, Jesse Allen. Thanks for joining us. Find us online, markettalkag.com, our home on the web. Markettalkag.com is where you can find us. All the latest market information, news of agriculture, and much more. It is all on our website at markettalkag.com. You can also find our social media links there and all of our streaming sources to listen to the show via Spotify, Apple Podcasts, SoundCloud, YouTube. You can watch the video version and so much more. Well, we had markets explode higher today in the ag commodities, the grains, oil seeds, the protein sector, all moving mostly higher here. Feeder cattle may be the slight exception to that, but really just a lot of bullish momentum, a lot to discuss. We won't waste time. Let's bring in our good friend Mike Zuzolo with Global Commodity Analytics joining us here this afternoon. Mike, it is great to catch up with you, sir. And what a day for us to talk and try to make sense of all of this momentum to the upside here today, Mike.
I think we've broken the streak of talking on down days at this point. We've really entered into 2022 with a counter cycle, an anti-cycle. Yeah, probably more questions than answers to the viewers as we close out today's session would be my guess, Jesse, because we're really dancing on some key issues right now, I think. In the day trade, excuse me, when it came to the grains in particular, soybeans joined up with the wheat and the corn. You and I have been talking, I think, a lot about how soybeans can't do it alone in order to break higher, fill the gap at that 1420 area, go on higher maybe to 1445 where there's some sideways resistance areas there and a channel, top of a channel there. So in order to get the front end market going to that price level, I've always had the idea that this has got to be done with the help of the corn and the wheat. We came back from the Martin Luther King holiday with corn and wheat finding support. And then the beans found big support with the bull being fed, thanks mainly to the USDA ag attaché out of Brazil, cutting the production for Brazil down to 136 million metric tons. That's 4 million less than the USDA WASDE report. What's more important, though, is he cut the exports by 6 million tons versus what the WASDE report showed us. So somehow, unless we ration demand, theoretically, those exports are going to go someplace else. And I think what this did to me in my analysis was it moved forward the market coming back to the weather and the supply and the next February crop report, trying to bring down the South American production estimate for a second time and not waiting to do that. Now they're going to go ahead and price that in at this stage. So this moves up as a result my timeline of when I want to sell into this market and make some more hedges, which would be between now and the end of the month.
You know, staying on this topic of the South American crop issues and how that's playing into everything right now, I know there's a lot of folks that are believing that the damage has been done to Brazil's first crop corn and soybeans and some Argentine crops. Yet I'm also hearing some in the camp saying, well, this happened last year. We saw big reductions, and then we ended up realizing that well, there's a little more crop there than we thought. I mean, you have a good connection to South America. What are you hearing from your sources in regards to the condition of those crops? Is this truly a situation?
It is. I mean, it is when you add both Brazil and Argentina and add additionally Paraguay to the case. Those top three producers in South America have had damage that's irreparable. I'm dropping from, I started at 200,000 tons a week on Brazil production cutting. That was back before Christmas, essentially a month ago, middle of December. I'm now ratcheting that up to 500,000 metric tons a week as of last week. So I am now at 139 and I'm going lower than that probably next week and maybe another 500,000 metric ton cut after that. It's going to be hard for me, though, Jesse, to get down to that 132, 133 level. So I think your point is extremely well taken. I think we need to remember what happened last year, as you rightly bring it up. We started out too high to begin with, knowing we came off a massive drought in both countries. Why did all these private estimates in USDA stick these numbers way up high at 145, 146 to begin with in Brazil? So I do think we're going to go like a rubber band from too big to too small. And I suspect we'll shake out at that 134 to 136 level when it's all said and done, if the weather pattern doesn't shift again. And that means Argentina gets enough rains, but it doesn't come in and just hammer them like it has in northern Brazil. And that goes back to northern Brazil. I think there's more damage potentially in the corn to come than the soybeans between Argentina and northern Brazil, because that safrinha corn crop gets planted right now as long as those beans get harvested. So if the rains continue, those beans won't get harvested, and all of a sudden you delay that safrinha corn crop back into February. That has a high likelihood of cutting the average yield substantially if they have to push it back that far.
Very key to watch the next week to 14 days to what happens in South America. You mentioned at the top soybeans needing to join up with corn and wheat, and wheat was the upside leader yesterday. And again, it's one of the upside leaders on Wednesday. We have the Russia Ukraine tensions, this geopolitical situation going on in Europe. And that seems to be the other big catalyst in our market trade today. How much, we look at that part of the world, Ukraine a big exporter of wheat and corn, Russia a big exporter of wheat, Russia a big crude oil country as well. I mean, you look at all those factors there. What are you hearing with that situation and how that played into us getting a strong move higher again in wheat and corn today?
I can't underestimate how little we know right now about what's driving this price action. We made an all-time record high in cotton futures today. The softs market's on fire right now. The agriculture market is being bought. A lot of us think that this has a lot to do with energy. You're right. Russia's number two exporter in the world of crude oil. We've got Iran and the UAE starting to bicker and slug it out a little bit more through the Houthi rebels in Yemen. UAE's in the top 10 of crude oil exporters. We're not making the cut in terms of getting enough output here in the United States. OPEC's not getting enough output up. I want to say they're about 1 million barrels underneath where they need to be right now, instead of a plus 400,000 barrels a day. So we're minus 1 million barrels a day. So I got to believe that this is commodity index buying. It's commodity index buying for one of three big reasons, or a combination, again, which I think we'll know in about 2 weeks which one of these or all of them are spurring this commodity index buying. It's either because the supply chain issue is not going away and the market realizes it, or it's because China is stimulating their economy substantially monetarily because of their property problems. And they just did it again this week by lowering their bank rate for the first time since October of 2020. They've lowered some of the other big interest rates twice in 2021. People are thinking they're going to cut their interest rates and their bank rates 2 more times in 2022. That typically really juices up the commodity investors and makes those commodity investors want to buy into this market in the futures. The third thing would be just it's crude oil. It's the fact that the commodity basket, because crude oil and energy is such a big player, it's a rising tide lifting all boats. I think it's probably going to be all three when it's all said and done, Jesse. But if it's supply chain in China, it could extend itself and kind of be like South American weather. It could go on for several more weeks, and we wouldn't really be understanding why unless we understood that these could be the features. So it's a stay tuned and be sure to keep up with market talk in these next couple weeks.
Another thing I know you mentioned to me as well before we went on the air is looking at the stock market. Stock market slipping a little bit lower here as we talk. What are your thoughts there? I know you have some concerns.
Yeah, the monthly low in the S&P 500 is 44.92 from December. If we take that out this month, that A would be counter seasonal, and B, it would be a sell signal on some of my longer term charts. The first sell signal I've gotten since the fall in that September, August time period. And we had a big break in that time period when I got that earlier sell signal. So I will pursue E-mini S&P puts for my guys that work in the equities markets and need futures protection for that, because I think the break could be just as big. The fear I have is that all of a sudden the stock market goes lower, but the dollar doesn't go lower, and we go into a recessionary, deflationary mindset. And if that happens, does that shut off the commodity rally? That's why I want to get hedges in place by the end of this month, especially on a rally here. I think it'd just be foolish not to with these kind of prices we're dealing with, because we can always defend those sales. By the same token, if the stock market breaks that December low and the dollar goes lower because theoretically the dollar's been strong in part because of the stock market being so strong here in the United States. If that dollar keeps going lower, that's going to feed probably into the crude oil market going even higher. And that $100 barrel of crude oil that people are whispering about right now, it could be a reality in 2 or 3 weeks based upon this kind of rotation out of stocks and into commodities. And that commodity index buying just keeps on moving, and the momentum gains and gains and gains. That's kind of how these markets work nowadays, especially when it's weather, supply, fear-driven markets, as parabolic sharp rallies we see that don't last very long.
A lot of things to watch, a lot of unknowns ahead. Would be having to watch things very closely. I want to make sure I back up as well to the soy complex. I know you shared with me a weekly soy meal chart. I want to pull this up and let you talk to us about this a little bit as well, and then we can segue from here, I'm sure, into the livestock sector. But talk about this soy meal chart and give us some of your thoughts on this.
Yeah, if you've never seen any of my analysis before, please go to Global.com Research and sign up for a trial, because last night I explained this in detail. And one of the big reasons that I don't want to sell nearby soybeans right now, Jesse, until I know more about the weather, especially given the attaché report today, and given the fact that Indonesia is also talking about limiting vegetable oil exports. That's still a red hot issue. But we also have this weekly soy meal chart. Soy meal's been kind of the weaker suit of cards this past year and 2 months. It started to come around here at the end of 2021. But notice what happened when the January meal went off the board last week and the March meal took over as lead month. We left a massive gap above this market on this weekly chart, all the way back up around $425 a ton. And so now you've got a blue trend line around 385, 390. That is your major support line that goes all the way back to the 2021 lows versus a gap to the upside. And so this is going to be, I think, an extremely volatile market. I think the fundamentals favor, even if we test that trend line holding, and we go back up and test and go through the current monthly highs and go, or weekly highs, and go ahead and take and fill that gap. This is one of the big reasons why, as I say in my research last night on the blog, I don't want to sell front end beans. I'd rather be in new crop beans, because there's a lot of uncertainty to the upside potential in old crop soy complex versus new crop.
Well, Mike, I want to segue over into livestock now, and I'll pull up the chart you have here on the video side, the feeder fat cattle spread and lead month. And, we look at the livestock today, cattle and hogs found some support as well. Some of that maybe spill over from everything else going on. I know feeder cattle were a little weaker, though, just because they got to manage the higher grain prices. So, I mean, talk to us about this chart a little bit, and let's get into the cattle sector with what you're seeing there.
Yeah. Now, this, again, I talk about this in my copy somewhat last night when it comes to the equities and livestock. Fat cattle and the S&P 500 have a positive relationship and have had a positive relationship with each other for almost a year, of 75% to almost 90% positive price action between lead month futures. So this feeder fat spread is getting my attention because seasonally and cyclically, we make lows in the feeders against the fats in Q1 and Q2. If you match up the stock market with the fat cattle, you match up the hard red wheat drought in the plains drought with the feeder cattle, all of a sudden this spread is going to be a major force in my analysis, because Jesse, if we don't take out the lows in the stock market and consumption comes back, labor comes back, I think the fat cattle market has a rally potential to it, because we're short bought, I think, at the packer level, especially given the wholesale prices jumping this past 2 to 3 weeks. Now, on the same token, so that supports your fat cattle price. By the same token, a continued drought in the plains is just going to force more lightweight placements into feedlots, sucking up more corn demand earlier than normal, and that keeps the feeders under pressure in relation to the fat cattle. So both of these things could keep this spread in its current trajectory of weakening in the feeders minus the fats, as long as the fundamentals stay the way they are. And that could suggest we go all the way down to that $15 level, which has been support ever since 2018, feeders in the lead month futures minus the fat cattle and lead month futures. So this is a very key player here. Would suggest to me that feeder hedgers need to be a little bit more eager to sell profit fat cattle guys and gals can probably sit back a little bit more and wait for more information. If the drought changes in the plains, then all of a sudden this whole spread could unwind itself, and all of a sudden feeders don't get placed. We go back to grass. We don't have a large number of placements available to the market in the feedlots. And all of a sudden they got to start bidding up. And all of a sudden we have that low in the feeders minus the fat. So pretty neat fundamentals, pretty neat cycle. I love drawing this out to people so that they can get an idea of what my analysis looks like.
Well, another thing too in this cattle market, and I know you alluded to some of the issues. I look at cash trade this week. Steady to maybe a buck 50 lower the south. I mean, and we're getting some of that cattle out for delivery end of the month into next month. I think that's another thing to watch in the cash trade as well. If we could start to ramp back up those processing speeds and the chain speeds, this goes cattle and hogs too somewhat. I wonder how that could maybe turn some tides in the livestock markets.
Yeah, I think that's a really key point. I think part of the reason why the hog market had such strength today was because of the pork and bean trade. The funds buying both soybeans and hogs, but we also really cut production back last week on the slaughter. We were only down about 1,000 head from what I remember on the fat cattle on the slaughter versus the prior week, and we gained, I think, a pound on the dress weights. But hogs were really starting to see the supply slip, and that's your labor, that's your chain speed you're talking about. And I think it's really important we keep up on that, because the better the hog price is, the better the ham cutout price is, the better the pork cutout price is going to be, and therefore the more competitive hogs are going to be with cattle at the packer level, and that just helps the fat cattle prices that much more.
Well, Mike, we touched on quite a bit. We still have some time. Anything else you want to mention, reiterate here today, whether we go back to the grain side or anything you want to make sure that producers really keep in mind here as we work through this week?
Well, I think the big thing that we want to keep a close eye on is that relationship between the crude oil, the stock market, and the dollar, because we talk about a lot, Jesse. That dollar's done a really good job for us in not pulling triggers and selling under pressure when it looked like maybe we should have sold some. But the market snapped back because the dollar was weaker. And I think as long as we keep a strong crude oil, weak dollar mindset, then the energy markets kind of trump some of the other factors that maybe could make the ag sector weaker. Because why? Those commodity index funds will want to keep buying and add to that basket. And I think this is where that supply chain inflation could go all the way into the second half of 2022. I think it will, especially unless China changes its policy on COVID. So this could extend that inflationary buying if the crude oil leads us.
You think if I'm a producer, should I get a little protection underneath me in case of something flip it around here, or uh, is it something maybe watch and see if we run higher, Mike?
No, I think this is a great question, because this is a great way to end it. What do you do with all this information? I had a client in Lafayette, Indiana, call me today and said, I can get 635 for cash corn. Do I sell it? I said, yes. Let's come back in then and buy Dees 22 corn as a reownership policy. Plus, it's a psychological reownership too, because if you go to $6 corn, you're naturally going to call me when I tell you to sell, but it's gone to 7, Mike. It's gone to 8. Well, that's fine, because we've already got the reownership on the books. So that's how I do this, because this is going to be a tough psychological market this year.
Well, Mike, I know if producers need some advice, they could reach out to you and look at your great analysis online. Tell them the best way they could do that.
Best way is to go to globalcomresearch.com. Obviously, if you're watching a video, you've got the internet down, you've got the email down. I send a lot of information out, but it's not too much to get through. So go to the globalcomresearch.com website, sign up for a trial, or if you want to call me toll free, 866-471-2588, please do so.
Well, Mike, plenty of knowledge shared with us today. A lot to talk about. What we got through it. I appreciate the time, sir, and we will wish you a great rest of the week. We'll talk to you next week.
As always, thanks for having me, Jesse.
Mike Zuzolo with Global Commodity Analytics, our guest today here on Market Talk. That's going to do it for the show on this Wednesday, January 19th. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.